Hello.
Hiya, Guy. How are you today, buddy?
How are you, sir?
I want to thank you so much for spending your precious currency, which is time, with us today. It's really nice to meet you. I've watched you over the years and respect your work very much, Guy, so thanks for joining us.
That's very kind of you. I appreciate that.
Yeah, well, I love your lucidity, and I'll get to it when we talk about the markets, but I'd like to start at the beginning. Could you give us a little insight into the beginning part of your journey and who influenced you and how you got into the industry, and perhaps you had mentors that showed you the way early on in your career? How were you influenced?
Yeah, sure. Appreciate that. And, hopefully I won't bore your audience to death. And I appreciate you having me on with you. And if I'm rambling, please stop me. I don't get offended easily. But I grew up in New York, small town in Westchester County. My parents met at Fordham Law School. My parents were both attorneys. And
cool.
My senior year in college, they were representing a gentleman that had recently left his job to go work at Drexel Burnham. And they asked him if I could come during Christmas vacation to come and interview at Drexel. So I did. Over the Christmas week. I went in every day for a week. And at the end of the week, they finally started talking to me, and they said, "Listen, kid, come back in May, and we'll sit you on the desk." So
was that during the Michael Milken era, Guy?
Pardon me?
Was that during the Michael Milken era at Drexel?
That was the Michael Milken. That was absolutely the Michael Milken era. And I'm not going to lie to you and say that I worked with him, for him, or knew him, but he would come to New York from time to time.
Okay.
We were down at 60 Broad Street. He was out in California.
Yeah.
But it was basically the halcyon heydays of Drexel Burnham. And I got to tell you something, for you Wall Street fans out there, Drexel was sort of the Oakland Raiders of Wall Street. And the street today is littered with people that got their roots and spent a lot of time at Drexel. So that's where I got my start, on the energy desk at Drexel Burnham, and I sort of made my way through. It was much more cutthroat than it is today. People would last anywhere from a day to a week.
Yeah.
There wasn't the grace period that you see in today's world, but it was Darwinism truly at its best, and for whatever reason, I was able to keep my head down and just sort of make my way through. And I was a commodity trader for about 15 years. I left in 96. And Drexel did go bankrupt, but our group got bought during the bankruptcy in 91 by AIG, and in 96 I left to go work at Goldman Sachs, the commodities group there, Jay Aaron, which again,
yes,
you talk about...
They were a force, Guy. They were definitely a force in the market.
They were a force.
Yeah.
And, and we still, I say we because I think, you never lose that, but they'll still answer the phone. They're Jay Aarons, and there's still a real pride to, the people that comprise that desk or that group.
So you were rubbing elbows with some pretty good traders in between Drexel and their bond trading, and were you on the floor when you were running the desk, or were you in an office?
Well, that's the thing. They started me back then. Your roots would be on the floor, and I worked on the floor of the Mercantile Exchange. And for any of your audience that watched Trading Places, at the end of the movie, there's a scene where they're trading,
orange juice,
concentrated orange juice.
Yeah. Yeah.
And that actually was filmed down there on a Saturday, and all the guys and gals you see were actual floor brokers that took basically their Saturday morning and went and filmed that movie. So that's where I worked, and what you saw in that movie is pretty accurate as to what went on. It was chaos, but it was, it was a great learning experience, not only about markets, but about sort of the ways of the world. So that's where I got my start. And to your point about rubbing elbows with some of the great traders, I will be the first to tell you that I was not one of them.
Mm-hmm.
But if you look at the management, the structure of Goldman Sachs as it is comprised today, out of the top 20 people at Goldman, 10 of them are probably Jay Aaron guys and gals. So that speaks volumes as to
the rest of them went to the Fed or in government, to the Treasury Department. Right?
That's pretty accurate.
Yeah, so you were in the country club of the elite, Guy. How did a middle-class guy cut into that country club?
Well, it's funny, and I understand what you mean by elite, but trust me when I tell you, these were some of the most intelligent, hardest-working people and most benevolent people that I've ever been around. So, I think a lot of times it's misconstrued that, you just get on one of these desks, you put your feet up on the desk, and you're making millions of dollars.
Right.
That's not the case. When you talk about, people throw 24/7 around, and it sounds glib and, it sounds like nonsensical, but the reality is those jobs are 24/7. So the sacrifices that those guys and gals make are significant. So, and I don't want to, trust me, they're not digging ditches and they're not fighting for our country. So I don't want to be melodramatic here, but they definitely put their time in, and they're some of the highest quality people that I've ever had the good fortune to be around.
Okay, so you were fortunate. A lot of people had to learn on the internet, which is a struggle because of all the hype and unrealistic expectations that people have, because they buy into trading for a living is easy. When I was a broker in Chicago, just getting licensed, a veteran pulled me aside and said, "Kid, it's a tough way to make an easy buck." And he was definitely correct. So let's move on to what Guy Adami is looking at to make a buck in these markets. I catch you on Fast Money quite a bit, Guy, and I know you've been sanguine on the Treasury market, the ETF TLT, and going into the Fed here. What are your thoughts and expectations on the Fed, and how difficult was it for you to stay with that conviction when we had a pretty impulsive move when yields went from 160 to 210, 2.25 in about 3 weeks?
No, that's fair, and I appreciate that, and I will say that, and I think you know this as well. I mean, my view on the TLT has been, it's probably going on close to 2 years now where I've been in that camp that rates are headed lower, and it's been difficult many times along the way. More so, 6 to 8 months or maybe almost a year ago, time sort of flies by, when everybody was convinced that the no-brainer trade of the last century was that rates were going to go higher. And, I sort of stuck to my knitting and held fast and said, listen, I think people are sort of missing the bigger picture here. And I still believe that deflation is the real bugaboo that we face, and we can get into that conversation as well. But, I do think that on a relative basis, rates in the U.S. are still headed lower. And, it's funny, everybody thinks the Fed has control, and I'm of the belief that the Fed lost control of the markets months ago, if not longer than that, and it's sort of a Wizard of Oz thing, because, as you know, if the bond market wanted to raise rates on their own, rates would be a lot higher. So there are clearly forces at work that people either fail to recognize or just don't want to acknowledge, and I think those forces is this global deflationary period that we find ourselves in.
So, another thing that I respect about your work is, I know you're talking about like the market right now. You were skeptical of this market, talking about equities now, for a while, but you never fought it, and it's tough to have a bias and yet go with the momentum of the market. So, congratulations on being able to do that. That isn't easy. In fact, it's hard to do. What do you think the pin is that finally pops this? We have, I was taught a long time ago, all bull markets are roofed in copper, and copper's been in a bear market for 2 years. It's the biggest roof. It's the biggest roof I've ever seen constructed. So, what do you think is the pin that pops it if it isn't going to be interest rates?
Dale, I got to tell you something. The fact that you were insightful enough to recognize, some of the things you just said is really music to my ears, because one of the things you learn being on television or being in radio or being in media is that, and I say this as respectfully as possible, that people hear what they want to hear, and that's just you can't fight that. There's no medicine out there to change that at all. So the fact that you recognize it, yes, I am. When you say skeptical, I think that's an understatement. I think this whole equity market is built in sand, but all along I've been saying it doesn't mean the market can't continue to go higher.
Right.
So to your point, that's not an easy thing. It's not easy to marry the two. And, I continue to wait and see what exogenous event is going to be the one that knocks this thing off the ledge, and I haven't figured it out yet. And frankly, over the last, 6 to 9 months, there have been a handful of things that appeared as though was going to be the event to sort of derail this whole thing, only to have the market just, ratchet itself back to all-time highs over and over again. Now, the problem with that is I think it fosters a complacency that is at best unhealthy, but at worst catastrophic, and I think that's what we find ourselves in now. People have been conditioned to believe that every dip has to be bought. You hear, the buy the dip sell the RIP thing, which to me is
Right.
meaningless and mindless. And you also hear there is no alternative, which I think is harmful as well. I think it's just, people love to put acronyms out there, and it makes them sound smart. But if you think about it, it doesn't make a whole hell of a lot of sense. So I understand why markets are going higher. I sort of get it, but it doesn't mean it's sustainable. And, I wish I was smart enough to tell you what event's going to be the one that's going to knock this thing or derail this thing. I'm not clearly that bright.
Right.
But it's going to be something, and it's going to be something that none of us see. It's never the bus you see coming that hits you, right? I mean, that's the old phrase. So I still think, at a certain point, deflation sets its claws in, and it's a spiral you can't get out of, and that might be it. It might.
How about
be
deflation with rising rates, the worst of both worlds?
Think about that, and you know what? That theoretically could happen. And again, I don't want to.
And not because of economic growth, but just because of the size of debt and the pressure to roll over that debt. Or how about the end of this bull market in the dollar, Guy? Could that be that's the linchpin, isn't it?
That's it. I mean, I think it's funny, I think all of those things. I mean, the rally in the dollar is not because, the U.S. is some panacea of growth. It's quite the contrary. The rally in the dollar is just because other countries are in worse shape than we are. I mean, that's just the reality of the situation. I would love to say that the dollar's rallying because there's some hidden strength there in the U.S., but if you look at the data, it just does not suggest that. And then people will point to the improving job market. But, again, depending on your dogma, you can make numbers look and seem to be whatever you want them to be. And in my world, and again, I'm trying to be as pragmatic and neutral as possible, I think the data at best is mixed, and at worst is somewhat negative. And the job growth that we're seeing here is offset by people leaving the workforce at a record clip. So,
yeah, I'm a greeter at Walmart. I'm in those numbers. So, a lot of low-paying jobs. Guy, I've often commented that without food stamps, we see breadlines as big as we saw in the 1930s, with 14% of the U.S. population on them. It's like an invisible depression to me.
Well, that's exactly. You were saying something I was about to say. I mean, people think the depression was in 90 years ago or so ish, but the reality is, to your point, there is actually a depression going on. People just, again, you don't see it or you don't want to acknowledge it, but I think, and please correct me if I'm wrong, but the stat that I keep seeing over and over again is I think 1 in 6 people in the United States are on food stamps.
Right.
And that is depression era stuff.
Right. What's your line in the sand, Guy, for the S&Ps, ranges that you're focused on going forward from here?
It's been so hard to fight it. You keep looking for a signal that it's going to turn or that it's some inflection point. Every time we get down towards the 200-day moving average, it magically bounces off it. We continue to make a series of effectively higher lows and higher highs.
Yeah.
I would guess, for this bull market to continue, you got to sort of take out the highs we made in late February, whatever that was. I think it was like 21.19 or something like that.
Some of the Super Bulls are in like the 2,500 camp. Do you think that's possible? I know anything's possible.
I think to your point. I mean, if you look at it, anything. For some of the sort of the rudimentary technicians, of which I am one of them, if you just go back to, the start of this whole, well, not the start, but when the market really started to get its legs underneath it in late 2012, when the S&P was, I want to say sort of 1150 or so.
Mm-hmm.
That was late 2011, early 2012. I mean, there's a really nice intact trend line that's an extraordinarily nice upward channel that we, from time to time, go down and test the lower end of the channel, but continue to sort of, as Dennis Gartman says, go from the lower left to the upper right. So
where's that channel line coming in nowadays?
If you look, again, I'm sort of spitballing here.
That's fine.
But it's the end of 2011 when the S&P was probably, want to say 1150-ish. And, the support of the S&P probably comes in around 2025 or so, and that's just sort of meatballing the whole thing together.
Mm-hmm.
But that's where support should be. But to your point, can this thing continue? As long as there's, I think as long as there's this belief that the Fed is all-knowing and all-powerful, and they are the buyer of last resort, the market's sort of on autopilot here. If you look at earnings, I think the chasm between earnings growth and revenue growth is probably as wide as it's been in quite some time. That is unsustainable, but it's been in place now for quite some time. You can only cut your way to EPS growth so long before there's nothing left to cut, and I think that's what we find ourselves in. Productivity is at not record highs, but flirting with record highs, which is great if you're corporate America, but it's lousy if you're an employee, and I think everybody can speak to that. So
a lot of this is also financial engineering with buybacks, et cetera, et cetera.
100%.
Yeah, so that is could actually exacerbate the whole fall with big companies doing all these major buybacks, and they're long a ton of their own stock. Who do they sell it to when the trend changes?
That's great. It becomes a scarcity thing. It's just, again, just sort of ham and egg, meat and potatoes economics. It becomes a supply and demand thing. There's just less supply of stock out there based on the fact that companies continue to buy their stock back at record clips. You talk about financial engineering. Sort of the poster child for financial engineering has been IBM, and it worked to a point. But, just go back and look. Think about the market, the broader market we've been in for the last couple of years, and then overlay an IBM chart since 2013. And this stock has basically gone from 220-ish, give or take, in the early portion of 2013. Now you're flirting with sort of the 155 level, and I believe on its way to 135 to 140. And this is a company that buys back stock at a record clip. And if you recently look, Qualcomm was a great stock for a long time, but then you go back to sort of July of last year when the wheels started to come off the bus. That stock's had a couple of downdrafts since July, and then I think a week ago Monday they announced a $15 billion stock buyback, and the stock went from 72 in the post market to about 75, and it's basically given that back and a little more so since. So what's my point? My point is, I think what companies look to is sort of a last resort ditch effort when things might not be going as well as they want. Their balance sheets are intact, and there's no denying the corporate balance sheets are probably the best they've been in quite some time, obviously aided by the policies of the Fed.
Right.
But again, when the final ditch effort is to buy back your stock, it's all about sustainability, right? And you wonder how long it can last.
I'd like you to put on your commodity hat for just a minute. In fact, I think I saw you yesterday, and you were talking about the crude oil market, this $10 recovery we had basically in 48 hours, and we moved sideways, and we're pushing new lows. The oil shares are still holding up pretty good compared to what the underlying commodity is doing. Do you still remain negative on crude, and can some of these banks' targets be hit around $35 to $30?
I'm not going to pretend I know where this thing is going to end, but I also have been around long enough to know that the market doesn't give you a sufficient amount of time to sell the highs, or in this case, buy the lows. So right. The fact that crude oil's been, and that's sort of an old commodity adage. So the fact that crude's been languishing at these levels for as long a period of time that it has leads me to believe that there's another leg lower. And I've been saying that now for a while, and that's proven to be somewhat correct. Yes. I also point to this OVX, this crude oil volatility index, which is slightly lower on the day, but is elevated to say the least. If you look at this thing historically, this index is something that sort of trades anywhere from sort of the high teens to the low 20s, and here we are trading close to 60. So, and this has been elevated obviously for quite some time. So
yeah, that's
amazing. It says to me that the volatility is not taken out of the market yet, and which means, again, says to me that there's probably another leg lower. I don't think, what's funny is, you'll have people come on, and maybe they're right, and I'm not saying I'm right, and I'm not saying they're not right, but they come on in droves and saying how positive it is for the consumer, the crude oil prices are going lower, and believe me, I get it. I drive and I go to the gas station, and it is a joy to, instead of paying $95 to fill up your tank, to pay $50. Like, I get that, and it is a lot of fun. But
that's been taken away from us in California.
And I pointed that out on the show, I think last week, or one of the shows, that asked the folks in California how they feel, number one. And number two, those cost savings have been more than offset by healthcare rises. So let's not confuse the health of the consumer here.
And
I also think that the move in crude is extraordinarily destabilizing for economies around the world, and at some point that's got to come home to roost as well.
And you're famous for saying gold always ends up in tears. Does the crying continue in gold? Some people looking for some kind of turn here.
You know, unfortunately, it's, you know, and I say this all, you obviously watch the show because I've said that numerous times, that, you know, it always ends in tears, and that appears to be what's going out. You know, if you had asked gold bugs, if you had sort of outlined what's going to take place over the last 2 years, 2 years ago, and then asked them what the price of gold would be, you would get answers anywhere from $2,500 an ounce to $10,000 an ounce. And the real believers wouldn't tell you what they thought because it would be so outlandish to the upside. And here we are, you know, either side of 1,100 or wherever it is. So, you know, obviously it's not worked out. So what's the gold story? I think the gold story continues to be a physical one. You know, the ETF market, as positive it was as a knee-jerk to the gold price when it was initiated, I think it's been that detrimental in the aftermath, and that's a longer conversation. But if you sort of look at what's going on in the physical world, there is real demand for physical gold, and at a certain point, that will affect the price to the upside. But again, you know, with the dollar strength, that's obviously put a sort of kibosh on things, and there are obviously other forces at work. But if everything plays out the way I think it will, and I hope it won't, but I think it will, then I think physical gold is not the worst place to be, because I do think you're going to see a stark appreciation at a certain point. You don't want to own the paper. I don't think you're going to want to own the ETF. I think you're going to actually want to be in whatever security allows you to own the physical. And again, I'm not that well-versed enough to be able to answer that.
Like a coffee can in the backyard.
Or like a coffee can. And listen, I'm not trying to scare people here and get all apocalyptic, but with that said, I mean, you just got to, you know, you can't ostrich up. You know, you got to sort of be aware of your surroundings and sort of see what's going on globally. And to me, it's not a rosy picture. I mean, think about what's going on in Europe with, you know, with the basically European Central. I mean, they're buying bonds with negative yields. I mean, people throw that around like it's not a big deal, but if you think about it for a second, I mean, what does that say? I don't even know what it says, and frankly, I don't think they know what it says. Desperation.
Yeah, desperation and naivety of people willing to pay people to hold their money for safety.
Yeah.
So, I obviously it's a deflationary scenario you're talking about, Guy, and these currency wars that continue unabated. I'm curious, there's so many hot spots on the globe. Putin's starting to bring troops up to the border of NATO members where we have a treaty, you know, bringing up things like nuclear, what's happening in the Middle East, will we have a good or bad deal with Iran, and does that matter anyway? What geospots are you most concerned about that you think could be one of the exogenous events to unwind things?
Yeah, I think you hit the nail on the head. I think you have to be worried about what's going on in Russia. I mean, I think you have to look at Putin as a complete wild card.
Yeah.
And I think you have to understand sort of what he's motivated by. And not that I'm some great geopolitical theorist or academic. I'm not at all. But I like to think that I understand history a little bit. And I think that's somebody that would love nothing more than to recreate the former Soviet Union, probably has complete disdain for the United States, and this is not a political comment, but probably has less than zero respect for the current administration, and is somebody that will continue to push the envelope. So I don't think that's somebody you want to trifle with. And the problem is, I think we've empowered him enough to feel that, you know, he can pretty much get away with whatever he wants, and you know, he will continue to, I think he's playing a masterful game of chess, and that's not to say that I think he's some genius. I just think he's playing his hand, and it should be scary, because I think what's going on there is extraordinarily scary.
Yeah, so isn't it a bad practice to create desperation in a world leader, a strong man, through economic sanctions to try and cripple him that way, because desperate people do desperate things?
no doubt about it. And don't think this move in crude oil is not in some way has its roots in trying to, again, I used the word destabilizing. I think the move in crude, a lot of it has been predicated on the fact that this is a way you can destabilize and sort of neuter what they feel to be sort of the wild card out there. But it's, again, to your point, be careful what you wish for, because when you back people like that in the corner, they're liable to do crazy things. So, and again, that's just me looking through my prism, and maybe I'm completely off base, and there's a very good chance that I am. But if you just sort of think about it through history, I mean, it's not as outlandish as it seems.
I have an expression, Guy, that trading is what we do, not who we are. And I know about your background as competing in Ironman competitions and the type of discipline it takes to be in shape to compete in those types of events. Is there a metaphor and a major benefit in your trading from what you do with your physical life in the Ironman contest? Because it's really, isn't it about never giving up and being persistent?
100%, Dale. I mean, and again, I'll talk about the Ironman because it's something I'm proud of, and it's not to be a big shot because, trust me, I'm not. But, I think if you do things for the right reasons in life, you're rewarded. And the reason why I committed to doing the Ironman a few years ago was to raise money for the Leukemia Society.
Beautiful.
And for a friend that had survived and is now going through his second round, which that was a longer story. But the point of it is, and I believe this with all my heart, the only reason I was able to finish that day was because I was doing it for the right reasons. And there were some things that happened on August 11th, 2012 that, if you didn't believe in God before, it certainly made you reevaluate those notions, because there was some crazy stuff that happened on that day. But in terms of discipline, it is about being disciplined, and 24 hours in a day is a long time, and you'd be surprised at how much time we waste on any given day. But, I took myself from 239 pounds, 6'3", 239, probably I would get out of breath walking up a flight of stairs. I got down in about 6 or 7 months. I got down to 189, and I was able to finish the Ironman in 16 hours and 19 minutes. I didn't break any speed records, but I finished. And that the real sort of the crux of that is we're able to raise almost $800,000 for the Leukemia Society, which I'd like to think changed lives and help save some lives as well. So, but to your point about being a metaphor for life, it is. I mean, you got everything you do. I believe you got to do with 100% effort, whether that's getting up in the morning and making your bed, or trading, or reading, whatever you decide to put your mind to. Do it with full effort and full attention. Otherwise, if you think about it, what's the point? Otherwise, we're just wasting our time.
That's right. Do what you love instead of doing it for the money, and the money will come.
Yes, because some of the most miserable people I know are some of the wealthiest people I know. So don't confuse happiness with wealth. I mean, happiness is, I am a firm believer in, you are and at the end of the day, you are the person that decides whether you're happy or not. And it's a choice. It really is a choice.
Well, Guy, I'd like to wrap it with, I'm so happy that I had a chance to talk to you and bring you to a different venue and share your outlooks on the world, on the markets, on philosophy of life. It was a great interview, and I want to thank you for being with us today, buddy. Good hunting to you.
Pleasure was mine. Again, hopefully your audience was entertained. I hope I didn't bore them to tears. But thanks for having me. Truly appreciate it. Hope to be on again.
Thank you, Guy. Adios, buddy.
Have a good day.
Thank you.